Because people are getting older, seniors are typically advised by financial experts to keep a large amount of money in the stock market for what could be a very long retirement. But the age-old question is, how much should you invest? Hi, Vincent Chan here from The Simple Dollar, and in today's video, we're going over how heavily should seniors be invested in the stock market. And if that sounds good to you, make sure you smash that subscribe button and ring the notification bell to always stay up with the latest and greatest on money and personal finance from The Simple Dollar. And remember, you can find more articles like this on thesimpledollar.com. Unlike savings account that typically give you a very low interest rate, investing in the stock market typically gives you a higher percentage gain with your cash holding that outpaces the rate of inflation. However, with this greater opportunity comes greater risk. When it comes to the stock market, there are no guarantees. During 2017, the stock market soared. However, heavily invested stock investors got a wake-up call when the market corrected itself. Periodic setbacks are easy to shrug off when you're 30s, 40s, or maybe even 50s. However, when you come closer to retirement, it becomes more and more important for you to actually protect your money because you might need access to those funds before the market has time to come back up. The stock market is very volatile and can take years or even decades for it to recover, which means that seniors that are heavily invested in the stock market may be forced to withdraw their savings or their funds from the stock market where stock prices could be really depressed. And therefore, they might be forced to take out a larger portion of their portfolio than what they had originally intended or what they're comfortable with. Deciding exactly how much of your portfolio you should be invested when you are coming to retirement is really difficult to answer because not one strategy fits everyone. However, there are a couple of key things that you definitely need to take into account. For example, one is what is your life expectancy? 2 is what is your tolerance for market downturns? And 3, what is your ability to actually live off of your savings without taking your investments into account? People who haven't saved enough money to retire on schedule might be tempted to invest a larger portion in riskier stocks in order to make up for lost times. This could potentially be the right option for you, but only if you are comfortable with market setbacks. And before I get into the next section with more advice and tips, remember to smash that like and subscribe button. As life expectancies have continued to increase, looking towards and relying on the stock market for a good retirement income has become more and more common, especially since savings accounts have traditionally offered very little interest rates, which offer very little incentive to put your money there. Although there is no single investment strategy that fits everyone, seniors should start taking into account the rule of 100 when it comes to investing in the stock market. This rule requires you to subtract 100 from your age in order to determine exactly how much of your allocation is recommended to keep in individual stocks. For example, if you're 65 years old, you would want about 35% of your investment portfolio invested in stocks. The big concern here is if you're even more aggressive than this, then you might not have enough time to wait out for the market to recorrect itself. On the other hand, people who don't like the uncertainty or the volatility of the stock market may find more comfort in investing in CDs or your savings account. To alleviate the pressure to invest heavily in stock markets, seniors should actually start saving up a ton of money before they actually retire. If you can live on income from your Social Security, your pension, or other types of income, then investing in the stock market purely becomes optional. Especially if you don't have the stomach for market fluctuations, then you can leave investing in stocks for other people. And if you do tap into your investments earlier than expected, do keep in mind that this could potentially bring you into a higher tax bracket. Some financial experts even recommend seniors who don't have enough money to actually fund their retirement to work a couple of years after their retirement age, which is traditionally around 65. The best solution might just be continue working for your current employer and just delay any retirement plans. So working longer, saving more, and delaying Social Security could allow you to afford a more enjoyable and secure retirement. In fact, research has shown if you just delay your retirement by 3 to 6 months, that it actually increases your retirement standard of living to equivalent amount of increasing your savings by 1% for the past 30 years. Although I do understand that there might be some health concerns for people working past retirement age, they could look into other opportunities such as working part-time. But the fact of the matter is none of us actually know whether or not working later on in life is actual realistic option, so the best solution for this is to actually start saving money now. As always, thank you so much for watching. If you have any questions, feel free to leave a comment down below and we'll get back to you as quickly as possible. And remember, if you want to stay up with the latest and greatest videos on money and personal finance from The Simple Dollar, remember to smash that subscribe button and ring the notification bell. Anyways, thank you so much for watching. Vincent Chan signing off.